Hello everyone. Let's review our PowerPoint slides for Chapter 9, Rental Activities. See what we need to learn in addition to what you read in your textbook. So, rental income is pretty straightforward. Most people understand what that means. We're renting out some kind of a property. Typically, we're talking about building real estate in this chapter. However, some of the rules do apply to renting machinery or things like that. Now, security deposits, when you receive them, are not necessarily taxable because you expect to return it. That means that it's not income. However, any first or last month's rent is, when you receive it, is taxable as part of your income, either whether you're cash or accrual basis, doesn't matter. Okay, so in this case, now the IRS has said that if you wanted to treat security deposits this way, meaning report them as income when you receive them and report them as an expense when you pay them back, rather than keeping track of them and not including them in income, and then later when you pay them, return them, not counting as an expense. You can do it the other way, but you have to be consistent. All right, so they did kind of say, well, we know it's for some landlords, that's a pain to keep track of those, so just count everything as income when it comes in. But this is the official rule here. There's the expenses that are available for renting. The one that gives us probably the most trouble is depreciation. Remember, we have two types of real estate. 27 and a half or 39 years, that should say. 40 years is for the ADS. Sorry about that. 39 years. And just a little note, rental furnishings, typical furnishings are 7-year property under makers, but rental furnishings are considered 5-year property. I guess somebody at the IRS decided that people in rental are harder on furnishings than people in their normal homes, but that's how that it looked at. Section 179 is not allowed on rental furnishings, but bonus depreciation can be taken. All right, now let's look at the situation. What if we have a situation where we rent part of the house and we live in part of the house? Okay, now this is the principle here is applicable to lots of areas of the tax law where we might use an asset partially in business, partially not. We came across that with our depreciation issues last chapter as well. So you're looking at the two sides of a duplex or something like that. You can always deduct the personal portion of the mortgage interest and real estate taxes as an itemized deduction, assuming that your itemized deductions are high enough. Okay, so looking at an example, we got a duplex, both sides are equal size. How you split the costs generally is based on size. However, you could use a, say, relative market value. Like, for instance, the bottom's level of a business would be maybe more valuable than the upper level because it's right on the street level, and therefore you could allocate more expenses to the bottom than the top. You could make that argument with the IRS, but typically it's by square footage. Okay, she rents out the side, what, 15,000, includes that in income, and then she splits these expenses. Okay, now utilities, this half that is for the rental is an expense. The half that's for my side, the part I live in, Sheila lives in, is just a personal expense. So that's not deductible anywhere. Okay, that's what's important to remember. But the half that's mortgage interest and the half of the real estate taxes that's for the rental is a rental expense, and the other half that's for our side goes on our Schedule A as an itemized deduction. And then, of course, there's something that's specific for our side is just personal. What about if we convert it from living in it to renting it out? Okay, that starts when you offer it for rent. When you move out of your house, can't sell it, so you decide to rent it out while you go ahead and move to your new house. Okay, but you still have this allocation between the rental portion of expenses and the personal expenses. You're looking at the time that you had it for rent. When you figure out depreciation, the basis in that property that you converted is either the lesser of the fair market value or the cost at the that you originally paid for it, adding any improvements you made to it over the years. So that's how you determine depreciation. Depreciation isn't going to start until you convert it and put it up for rent. When you were just living in it, there is no depreciation, because depreciation is only for assets used in either to produce income like rental or in a business. Your personal assets do not have any depreciation. You don't go back and calculate past depreciation or anything like that. Okay, example, we moved out on April 1st, but it sat there till October 1st, couldn't find anybody to rent it. We get to start taking deductions for the expenses on April 1st, and then the depreciation starts that same time based on either the adjusted cost, which we originally paid for it, or fair market value, whichever is less. Now, vacation homes. All right, the second house. So we've got our main house, and now this is our second house. And if we rent that out for 15 days or less during the year, you don't report any income. So there's a big event in town, so you decide in a place, you just rent it out for a couple of weeks because you can get a really good rate. As long as it's less than 15 days, you don't have to report any income, but you don't have any expenses either. Okay, so this is still just a second home, second personal residence, and you can deduct the mortgage interest. Remember the limits from Chapter 5 of how much it can be, and that it's only one other vacation home, and real estate taxes as on Schedule A. Now, real estate taxes, it doesn't matter how many houses you have. You could have 6 houses, and all of the real estate taxes would be deductible. Of course, remember there's a limit on that too, right? For itemized deductions, $10,000 for a married couple, and $5,000 for single. So you're not going to get that as good a benefit as it used to be since that limit came into play. So here's the Canes. They collected $5,000, were renting their main home for 10 days. That's a pretty good darn rate. Okay, it doesn't really matter which home it is, main home and a second home, whichever. Okay, but because it's less than 15 days, they don't report the income. The mortgage interest and real estate taxes are going to then be deductible as itemized deductions. The insurance, utilities, and depreciation are just personal expenses and don't get deducted anywhere, because there's no rental income equals no rental expenses, because this 13.8 really are not rental expenses. These are itemized deductions. Rental of vacation homes, it gets more than 14 days. Now we're talking about allocating the cost between the rental part of the property and the personal use. Okay, so if we collected $10,000 for renting out the second home for 60 days during the year, we have to report the $10,000, right? We get to deduct part of the 15.2 and part of the insurance, utilities, and depreciation. Remember, when there was no income, there was no expenses for these three. But now that there is income, we could deduct part of this, not all of it, but part of it. So how do you allocate that between the two uses? Okay, well, most of the time you're going to use days rented at fair value divided by the number of days used total. So this is your rental days. This is all the days that were used, your personal use, everything used during the year, and get that ratio, and then you multiply it by the amount of the expense to see how much you're going to deduct. Right? The IRS says you have to use this calculation for all rental expenses. However, the tax court determined that for taxes and interest, you can use this formula, days rented divided by 365. This is only for tax and interest. You have to go back to the other formula for all other ones. So basically the idea is that taxes and interest are over, doesn't matter, you pay those whether you use the property or not. So the better, the more applicable thing is this for the whole year. Okay, this makes it less likely you have to carry over expenses, meaning you have less taxes and interest expense for the rental, which means you may be able to use some of your other expenses, because a rental income, a vacation home like this cannot have a loss. You cannot have more expenses than income, otherwise they have to be carried forward to the next year. We'll come back to that idea in a minute. Okay, so what does it mean? Fair rental, okay, days properties offered rent but not actually rent do not count. It has to be they pay the fair rental price. So if you give anybody a discount, family members, things like that, that's not going to be fair rental unless they pay fair rental. Okay, all days occupied. Okay, if it's vacant, it doesn't get counted in this calculation. So when you have a residence, meaning that it's going to have more than 14 days used personally, or 10%, then you cannot have any more than the expenses, any more expenses than you have income. All right, and you do it in this order. First, casualty loss, no longer deductible, okay? Then directly related rental expenses. Then depreciation is always last. So depreciation is the most likely thing to be carried forward. Remember, it's a residence greater than 14 days or 10% of the days a home is rented. Okay? So looking at personal days and what that means, okay? Anything other than repairs and maintenance. So if you're there at the vacation home and you're making repairs, that day does not count as personal use. If our family members are using it, or someone is a friend of ours pays less than fair rental price, that's personal. All right? Family members use their home for purposes other than as their main home. So they go on vacation. Even if they pay fair rental price, it's still personal use. Okay? Or if you donate days to charity for like a charity auction or something. All right? So, examples. Rents out a second home 45 days. We spent 35. 5 of those days we painted the exterior of the house. So my personal use is 30 days. The 35 minus the 5, right? Because those don't count as personal days because we were painting. It qualifies as a residence because we're still over the 14 days or 10% threshold. Okay, 175 days during the year, parents used it. We didn't use it at all. Baxter didn't use it at all. Parents did pay a fair rental price. Remember, exception for family members. Even though family members pay rental price, is not their main home, so they count as personal days. But because they paid a fair rental price, they also count as part of the rental, fair rental days. So now you're dealing with 192 days. So it's not a residence because the 17 personal days are not over 19.2. Remember, it was the greater of these two, 14 days or 10%. and 10% in this case is higher. So we're not over that, so this is not a personal residence. So we would not have to allocate these expenses. They would all be rental, okay?